Hello guys and welcome back. In this video we're going to talk about a trendy company right now which is up about 70% in the past couple of days. Crazy stuff going on. Didi Global. And this is a company like Uber pretty much. Think about it as the Uber of China. You can see that it operates in China, Brazil, Mexico, internationally. Ride hailing, taxi hailing, software and things of that sort here. Now, this company, if you take a look at the stock analysis chart, you will see that it has been completely demolished here. It has gone down about 90% before this, probably more than 90% before this 70% move in the past couple of days. But take a look at the 1 week chart here. It has been climbing a lot from almost 1.82 dollars to 2.54 right now. So a massive increase. Let's see if that continues. But we need to see what happened, like what caused this 70% increase here. You will see a lot of articles here talking about the fact. Here's why Didi jumped 50%. Delisting provides short-term upside potential. Let's take a little bit of a look. You will see here that here's why Didi jumped 50%. You may have heard about this. China was actually regulating some of the applications from the company, so they pulled them from the domestic stores, and so people were not able to obviously basically download those. And so they actually finished their regulation, and so they are reinstating the applications in the domestic app stores. There's going to be some penalty, some fine, I have heard, but overall this is a massive positive, of course, for the company, because people are actually very happy that the applications are actually back on the store, so they can continue their operations as normal. There's not going to be much more regulation going on, it looks like. And so this is of course very positive here, and you can take a look at this article as well. Delisting provides short-term upside potential. You'll see this one, which I have marked here, at a price to sales of 0.33. The fear around Didi seems to be over-exaggerated. Now, you can actually pick and choose the best metrics, really, the ones that fit your story, and it looks like this article may be doing that here, because if you pick the price to sales ratio, yeah, this one is low because the price of the stock has been completely annihilated. But what about the profitability? What about the free cash flow? What's going on there? So we will examine that, of course, using our tool, because we need to pay attention to what is actually happening with the company and not just follow the buy here. So let's examine what is actually happening with the company. Even after it has been dropped that much, we don't necessarily automatically buy the company just because it has fallen off a cliff. That's not how we invest. We want to be buying companies that are valuable. Now, if you want to trade this one and maybe get some money as it's going higher, well, yeah, maybe that would be an interesting buy potentially if you're a trader. But for a long-term hold, now we need to examine our financials here. And you will notice the first thing, price to earnings ratio and price to free cash flow ratio are both very negative here. This becomes a bit of a problem, because how do you value these companies is the problem here. How do you actually value these companies? They're making negative income here, net income. They're making negative free cash flow. So how are you gonna deduce what kind of cash the company will generate? They will not be generating cash. They will actually be losing money. And so what you can see is actually the factor at which they are losing money. So basically here, you will notice that net income has been growing into negative territory. It has been going backwards instead of actually going higher. So this is a very bad sign. And the same thing, of course, with the free cash flow. And it's only the equity that has been climbing a bit, and of course the sales, even though not much, but not by much, of course. And you will see here outstanding shares from 2.5 almost billion, 2.6 to 4.8 right now. So this is a massive increase in the outstanding shares count. Very diluted investors here holding the company. Another thing that I hate to see. Now, if we take a look at the debt, the company doesn't have much debt. You will notice what the article was talking about, very low price to sales ratio, which it's a little bit more than what it was, but still very low. But net income margins negative, return on equity negative, basically negative profitability here is something that you hate to see. And frankly, as I'm looking at this company, this is basically a rejection by me pretty much instantly. Just because the company is not making money here, is not having any free cash flow, it's diluting stockholders insanely. Things are looking worse and worse. It's also net income growth is actually going negative instead of positive. And so the trajectory looks negative here. And also, if we take a look at the financial statements, you can kind of see that 19 billion to 27 billion, and then minus 2, minus 1.3, minus 1.6, and then minus 7.7 in terms of net income here. And that's losses, of course. And a balance sheet that has a total equity of 19 billion, but take a look at the retained earnings here. This is the cumulative account, which actually describes how much losses the company has been having through their net income through the years. So it's going worse and worse, from almost 10 billion to minus 21 billion here. A lot of debt for the company here that keeps increasing, not tremendous, but still. And there are tons of issues here, and the total liabilities at 4.3 billion here without the company making any money really at the moment. So these are problematic. Look at this additional paid-in capital. $40 billion of shares is what the company has been actually issuing to shareholders. An insane amount of shares. Basically, the company is operating through shareholders. Otherwise, they would have probably gone bankrupt already, or they would have had to get tons of debt to sustain their operations. It's not looking great. And again, the cash flow statement is also in the negative. You can see here minus 3 billion for the last year, from minus 2.1, what was it, 2018. So this is not looking great. And if you take a look at the stock evaluation tool, you'll be into negative territory, negative net margins here, negative cash flow margin. You're looking at these cash flow margins being positive, but they are not positive. It's because of the division. Division happens between the net income and the free cash flow. And so if both are negative, this is going to give you a positive margin. But practically speaking, these are negative values, so there's nothing to see here. So what can we do? What we could potentially do is guess. So we can guess that the company will eventually have some growth. Actually, the growth that they had has been about 14%. For some reason, this is actually not correct. But practically speaking, it's about 15%. But we can go maybe 8, 10, and 12 here. And 12. And so the net income margin that we can use potentially, we could do something like marginal profitability. Let's go 2, 4, and 6. Free cash flow margin 80, 90, and 100, and 13% for the annual return. And if we hit calculate here, you will see that our low estimates are 1.53, which are red, but the medium ones are within our limits. That's because the stock price is massively cheap here. But remember that we are assuming that the company will achieve positive net income margins, which they haven't been achieving. They are much into redness over here, as you'll see. So they have to significantly improve their operations in order to reach this, like by a lot. And so I'm not seeing that happening anytime soon. So if you're buying this one for a trade, it's probably a good idea. For a long-term investment, maybe if you are like a risk of, if you actually like some risk, if you like to take some risk, this is a risky proposition. It has gone down a lot, but maybe you can over the years reap some benefits. I myself, I wouldn't enter this one as a long-term hold. I don't like what I'm seeing here. And however, as a trade, I think this could be an interesting opportunity, and maybe some company to at least have in your short list. Take a look at this one every now and then, see how they are doing. Thanks for watching, guys. I hope you enjoyed the video. Remember to leave a like and subscribe, and I'll see you in the next one. In the meantime, take a watch at this video that I made earlier, and in this one I'm discussing PayPal, a very interesting company. Let's see if this one is a buy. Thanks again. I'll see you soon. Bye-bye.